Morning everybody, and welcome to the Aquila Markets chart update today on Friday the 19th of March. As always, before viewing any of our content, please view all of our terms and conditions and disclaimers at aquilamarkets.com. So let's get right into it. What a week it's been, bunch of central banks, but let's really start with the Fed. Let's just boil it down. The Fed's message was simple. We are going to create 2% inflation come what may. What was fascinating about the response to the Fed's announcement was that despite the fact that they basically forecast an increase in inflation above their 2% target and forecast growth higher, and we even saw certain members moving the dots higher, in other words, bringing forward the potential of rate hikes, it's very, very clear that the core of the FOMC, led by Powell, is refusing to consider any removal of monetary policy at the moment. But the issue for us is this time it's different. And the reason it's different is that in the last year, 25% of GDP in fiscal response has been dropped from the sky. In other words, there is so much money washing around the system, so many dollars. And I think Powell looked really pretty chipper in the press conference on Wednesday. Also noticed that he kept reading from notes. There was clearly a very strong message that he wanted to put out, and he wanted to stay on message. I think he's happy because he knows they're going to finally reach their goal. Their self-set goal of 2% inflation on the core PCE measure. Why is it 2%? Nobody knows. But it basically is the choice that they have made in terms of the target that they want. They then believe that they can get inflation running just ahead of 2%. And then they can come and magically create control and just create this wonderful world with very, very low unemployment that's doing all sorts of wonderful things. They're combating climate change. They've managed to do all the rebalancing around all the inequalities, and they're going to hold inflation at 2.01%. It's so hubristic. In other words, the arrogance that they have that they can believe this is just simply extraordinary to us. What's been really interesting in the reaction to the markets after that is the bond market. And the bond market said, we think you're making a policy mistake. And because of that, we've seen bond yields spike to the upside. We've seen the dollar go a little bit better bid. And what we've seen is positioning starting to be cut in lots of markets. And I think that's been one of the themes that we've seen recently, is this idea of markets being idiosyncratically taken out in terms of positioning. This week it's been oil. So let's look at oil. Huge sell-off yesterday, and oil down 9% for the week. Massive sell-off. And we know that oil has been a big mover to the upside. We've liked the XOP ETF. As you know, we took it off on Monday because we just felt it's just been a fantastic trade for us, and it was time just to book some profit. But if we just come and look at what's happened over the last week, the dollar index has not really moved very much. It's still pretty stable. So S&Ps are down a little bit over the week, but they're still jammed against the highs. Look at this percentile, 96% percentile. But this is the one I want to point out. Just look at this move in yields. This move up well above 1.7 now. The market constantly is having to get used to this concept of higher rates. 2% is the rate that I think people are starting to talk about as maybe the key one for the 10-year. We're going to look at this in a minute in quite a bit more detail. But how the market, and particularly equities, react to this higher yield situation is really, really important. So let's come and look at the sector dashboards in equities. Let's just look over the week. Huge weakness in oil and gas, in energy, IPOs, metals and mining. So in other words, this is just a massive liquidation move, and we can really see that because even the GDX gold builders, and we talked about this with our video on Tuesday, about whether we were starting to see gold as a potentially interesting asset again. We know that it's competing for Bitcoin for the anti-dollar trade. But that doesn't mean it maybe necessarily doesn't have a place. We're not sure yet. It's not on the radar screen, but it's certainly something we're starting to think about. And the other point that we want to make is credit just continues to look soft. And of course, higher rates is just not good for companies whose existence is allowed to occur because rates are basically zero. Quick look at the radar screen. No additions or takeoffs on the radar screen this week. Core plays, as you know, it's got this risk-off bent. Long the dollar calls, long the euro-dollar put spreads, and long dollar yen, obviously. And against that, we've got our emerging market ETF downside. That's the China pullback play. The Russell, that's another one of our fastest horses play. And the VIX. And one of the things that I think is really interesting, just coming back here, is let's just come and look at the VIX. Head back onto this one. This thing is bouncing around this 20 level again, which we just think is a really important pivot for the VIX. Just watch the VIX really closely. FX vol has all ticked higher, look, over the past couple of days, even with FX kind of being relatively stable in terms of the overall moves. It's a signal for us that next week, today we have quad witching, so we have a huge amount of expiries, obviously, in equity and equity options. Next week, we've got so much going on, including whether we're going to see this big rotation, which is going to, into month end, which is going to cause equity selling and bond buying. Really important to remember that. What I want to talk about today is inflation. And I want to talk about real yields, and people throw around this, real yields, what do they mean? Let's just remember what real yields are. Real yields are nominal interest rates minus what people perceive inflation to be, inflation break-evens. Now, the break-even inflation in both 5-year and 10-year is around 2.5%. But what's really interesting at the moment is we have a Federal Reserve that is trying to be as dovish as they can, whilst at the same time telling us that growth in inflation is going to pick up. So it's creating this huge level of sensitivity in the market. Now, the fact that break-even inflation expectations effectively, are around 2.5% in both the 5-year and the 10-year tells us that the market believes that Fed is finally going to create inflation. Great. But one thing I think that's really interesting is if you look at the real yields in the 10-year, which is in blue, and the 10-year and the 10-year real yields, which is here in white, we can see that whilst this is obviously moving here to the upside nicely, this is the 10-year where real yields are getting closer back to zero. And of course, we'd expect real yields to be positive. We'd expect interest rates to be higher than inflation, or we know that policy should be extraordinarily accommodative. This remains very, very low. The 5-year real yield is still down here at minus 1.8. And why is that? It's because 5-year rates are 0.85%, while the 10-year rates are at 1.7. In other words, the vulnerability of this market is potentially not long end rates. It's actually these rates here in the 5-year, and to start seeing front end rates really moving up. And let's just come and look at this chart. And what this is basically just a simple chart since 2018, 30-year, 10-year, 5-year and 2-year rates in the US. So let's just remember something. In November 2018, all of these nominal rates, all of them were at or above 3%. Even the 2-year was up here, look at 3%. So then we had the huge sell-off. Now, this obviously was this period of gradual slowing in the economy that we were already seeing throughout 2019. This was already something that was happening before COVID. And we saw this slowdown, rates went down, COVID collapsed. Now, just to check this out, the 30-year rates are roughly back to where we started from. 10-year rates have still got a way to go. The 5-year is nowhere near. Look, the 5-year, when we were here at the beginning of 2020, was up at 1.8%. It's at 0.8. And the 2-year is anchored down here. So what we think is happening is it's like a rope being pulled, and as the rope gets pulled up, the end of the rope takes longer to pull up, but then it eventually goes. So we have this slingshot effect, and this is what we think is happening. First the 30-year goes, then the 10-year, then we get suddenly the 5-year going, and even the 2-year is that starting to tick up. In other words, Fed is committed, totally committed to combating inflation, but it's now being helped with this 25% of GDP fiscal stimulus. The issue for the Fed is if this suddenly starts to go higher, because suddenly the market is going to really price in the growth. That is going to cause inflation to really start to potentially become a big issue. But those higher rates are going to really be negative for equities, because equities rely, as we know, on low interest rates. So I want to put this chart in. Remember, you can pause our videos and look at it. This is an old favorite chart of ours here at Aquila Markets. And it's basically the S&P, just a monthly chart annotated with the key events. One of the reasons why I love this chart is it creates the perspective that I always think is really important to think about. Let's just look all the way back here in the early 90s. This was the NASDAQ bubble up here. Lower, this is when the Fed cut rates. 9/11 was here, obviously, US recession. The Great Moderation, this was when we went through that extraordinary period of extraordinary credit impulse, particularly in the US. US housing bubble bursts, notice the double tops. And then suddenly, all these repeated interventions from global policymakers expanding global balance sheets that drove equities higher. This was the China devaluation and the slowdown in 2015, 2016. Here was Brexit. Trump was elected here. And suddenly notice we get this big pickup in volatility that really started in the late part of 2017, early part of 2018. Something that we call volatility returns. Here was the COVID sell-off, gigantic in terms of its size, in terms of absolute number of points, before that massive rally caused by the extraordinary amount of fiscal stimulus, which we've talked about, and finally the COVID rally, the COVID response rally, Biden elected, vaccine rollout, fiscal stimulus, everything else. One of our questions that we keep asking ourselves is, can a US economy and a strong US stock market coexist? And we think not. because a strong US economy is just going to see interest rates that are just so much higher, and equities are so totally trapped in the narrative of wanting to see lower rates. And so the final chart that we want to show you today is that if we really believe there's going to be a policy mistake, we wonder whether gold starts to look increasingly interesting as a diversifier, as an inflation hedge, as a safe haven, all the things that gold does. But here's an interesting point. Not just long gold against the dollar, but what about long gold against the euro? We remain fundamental bears on euro dollar on a positioning basis, a sentiment basis, fundamental and a technical basis. So is short euro versus gold a better play than short the dollar against gold? Or is some basket trade kind of out there? So we're going to leave you with that thought. We're starting to really think about that. We don't have it on the radar screen yet. It's not a trade that we have on, but we're really starting to think about it with great interest. That's it from us for this week. Have a great weekend. Next week, a huge amount of market-related data to look forward to. But remember, the best news we ever get is market price action, and that's why we watch it. Have a good one.